This video examines NTPC, the elephant that learned to run, focusing on the narrative of hype versus reality and the core business of energy security. India's power demand is growing, and NTPC is a primary beneficiary of regulated return projects mandated by the government for massive thermal capacity. However, the NGEL IPO underperformed, fading the initial value unlocking excitement. Looking at the financial health for Q2 FY 2026, NTPC reported revenue of 44,785 crores, which is marginally up year-over-year. Net profit was 5,225 crores, up approximately 12%. The profit growth is driven by capacity addition and operational efficiency. NTPC remains a dividend king, declaring an interim dividend of 2.75 rupees per share, consistently paying out 40 to 50% of profits. The newly listed subsidiary, NGEL, is a drag due to struggling market sentiment despite aggressive valuations at IPO. The strategic triggers highlight a thermal supercycle, with India adding 80 gigawatts of new thermal capacity. NTPC has already awarded contracts for over 15 gigawatts of new coal plants. These regulated return projects guarantee a 15.5% return on equity and provide earnings visibility. NTPC is also entering nuclear power and aggressively bidding for pumped hydro storage projects, which is a high-margin business supporting grid stability. The red flag checklist includes subsidiary underperformance, where the NGEL stock is languishing below its IPO price, creating a valuation drag. Secondly, as a regulated entity, NTPC's profits are capped by CERC, unlike private players. Finally, the massive CapEx plan, exceeding 20,000 crores per year, limits the ability to drastically increase dividend payouts or buybacks, despite manageable debt. The technical outlook shows strong support levels at 315 rupees and 295 rupees. Resistance levels are at 345 rupees and the 52-week high of 371 rupees. The current price is 324 rupees. The observation is that the stock is stuck in a range, with drawing volumes indicating a lack of aggressive buyer interest. The view is that it is an accumulation zone, with limited downside risk of 5 to 7%. As of December 29, 2025, NTPC's price ranges from 324 to 326 rupees, with a market cap of 3.14 lakh crores. It is a mega-cap power sector leader in power generation. The current trend is sideways to consolidation. The valuation is attractive, trading significantly cheaper than private peers, with a PE of about 13.6 times and a dividend yield of approximately 2.3%. The final verdict suggests a buy for defensive and dividend investors, viewing NTPC as a safety bunker with a guaranteed return and a 12-month target of 380 rupees. For growth chasers, it is advised to avoid this slow-moving stock, suggesting alternatives for explosive gains. Existing holders are advised to hold, as the green energy disappointment is priced in and earnings are expected to spike in 2026-27. If you found this stock review helpful, please like, share, and subscribe. You can also drop a comment on the stock you would like to see reviewed next.